Hello everyone, today is June 1st, so we're going to go over how our portfolio did in the month of May. So we can see that we're currently at $18,114, which is an all-time high, but keep in mind that we did adjust our weekly deposits up to $100, so this number is off by a little bit. But nonetheless, we can see in the last day we were down 0.14%, the last week we're up 0.62%, and for the month we were up 5.68%. So first of all, let me say this is great to see. I didn't expect to have an up month, honestly, because if we look at the 3 months over here, we can see the struggle that the market had. At our lowest point over this time period, we were down 14.75%, which is an incredible amount, even for an entire year, let alone a couple of months. But it seems like Trump decided to walk back on his tariff policies quite a bit, start working with other countries, put off the gas on China a little bit, hit the brakes, and that kind of gave a lot of relief to the markets. And we can see from that we went from being down 14.75% to eventually being up 3.67%, which is a 17% difference in valuation. So when we're at that lowest point, we put a $500 deposit in, which felt pretty good. We're able to get our valuations a little lower on some positions, and eventually that just allowed it to keep pushing up. So we saw last month that it pushed up quite a bit from being down, but that trend continued for this month. And although we saw it at a higher point and then it pulled back about a percent and a half over the last month, I mean, being up 5.68% is nothing to scoff at, and I'm very happy with. So you'll see over here that we have something different. We only have two positions. So last time we had Google, and it was a smaller position, granted, but when I did that $500 buy-in at the bottom, I did actually try to lower my cost basis for it, and I did. And it eventually went up quite a bit, and I was happy with it because it went from being down a lot to being up a little bit. But I saw a lot of concern in Google's stock valuation, and normally I wouldn't fret because it's been such a short amount of time, but I saw issues in their disruptance of their search engines. They're not staying up on the AI. I mean, they're losing market share greatly that way. And although their revenue has been increasing, I don't see it staying at a consistent rate going into the future unless something consistently changes with the company. So I felt that the profit I did take out of it, I was fine with cutting where it is. And we'll talk about that at the end of the video, but I felt like annualized, given the market conditions, it was fine. Um, and of course, right after I sold, it went up, what was it, 3% the next day, 2% the day following. So, my luck on that because I was holding it for over a month. But we take what we can get. I'm not going to be upset with it for getting out what I thought was a great time. And I mean, if we look at it, we can see that even after that, it did pull back a little bit. So I was holding GOOGL. Look at 3 months, we can see that we started buying actually when it was kind of at this 190 point, and it pushed down quite a bit. You can see an all-time low at 144, and then we'll look at that in the video, but I think we sold around this point, and then of course it went up a little bit, but it's been pulling back again. And that's the issue I was having with Google. It doesn't really follow the market quite well. You'll have market days of being up 2%, and Google's trailing at 0.2%, or might even be trading down for the day. So it's something that was quite annoying to see, and we're learning how to evaluate stocks properly, but I was pretty happy with that. We're going to be looking into adding new positions, especially now that I have time, now that I'm graduated. So stay tuned for that. I would love to have my portfolio range from my 2 index funds and probably 5 stocks maximum, just so I keep track of them and hopefully I'll perform. But yeah, I don't really wouldn't want to go beyond that because even hedge fund traders and top investors, they have 10 positions, 15 positions max. Anyone beyond that, they don't necessarily know what they're doing, and you'll see their performance as otherwise becomes very expensive, a lot of evaluating during their time. They just can't keep up on the stock. So we're going to try to keep it relatively low because I'm still working on that evaluating muscle. So 5 positions top, but keep in mind this will slowly happen over a year, 2 years. So we'll start looking for that first position I really want to get in and stay on this account for a while. But in the meantime, nothing really sticks out to me too much, so we're going to have to do a lot more market research and go from there. So as we established, a lot of the market gain in the last month was seemingly this backpedaling that Trump had on tariffs with other countries. He seemed more willing to work with them. He felt the pressure that the markets were giving him since they were all just plummeting after the news of his reciprocal tariffs. And this video right here is a great example of a reporter asking him about his seemingly changed stance on it.
Mr. President, Wall Street analysts have coined a new term called the taco trade. They're saying Trump always chickens out on your tariff threats, and that's why markets are higher this week. What's your response to that?
I kick out?
Chicken out.
Oh, isn't that nice? Chicken out. I've never heard that. You mean because I reduced China from 145% that I set down to 100 and then down to another number? And I said you have to open up your whole country. And because I gave the European Union a 50% tax tariff, and they called up and they said, please, let's meet right now. Please, let's meet right now. And I said, okay, I'll give you till July 9. I actually asked them, I said, what's the date? Because they weren't willing to meet. And after I did what I did, they said, we'll meet anytime you want. And we have an end date of July 9th. You call that chickening out? 6 months ago, this country was stone cold dead. We had a dead country. We had a country people didn't think it was going to survive, and you ask a nasty question like that. It's called negotiation. And in many ways, I think we really helped China tremendously because, you know, they were having great difficulty because we were basically going cold turkey with China. We were doing no business because of the tariff, because it was so high. But I knew that. But don't ever say what you said. That's a nasty question. Go ahead.
Mr. President,
To me, that's the nastiest question.
So yeah, the reporter here made a great point that it seems like Trump always chickens out of these tariff deals, that he initially is very bullish on them, says this is what's going to fix the country, but then gradually and almost consistently seems to pull back on the percentage that he's going to be tariffing. I mean, he went on China from 140% to 100% to 30% or so, seemingly just bringing that amount down more and more as negotiations happen, but China has consistently said that these negotiations aren't happening and that Trump is just kind of manipulating the news with it and trying to work back these tariffs in a way that doesn't make him seem like he was wrong in the first place. So it's quite interesting to see this development. And we do have more news with the tariffs recently. We know that his reciprocal tariffs were struck down at a court, but then the level above that court had to appeal it. So it's going to go up further in the court system to see if these reciprocal tariffs are even legal to be done by the executive branch. And this has kind of had markets mixed. So they like the fact that they could be going away, but they're concerned because the appellate court here said, no, actually they're okay. So it seems like there's a likely chance that as they go higher in the court system, that there's a ruling that says these reciprocal tariffs are legal. And if that's the case, then there's nothing to stop the president from doing them. And that's just going to hurt the cash flows of all these companies, bringing valuations down. So this is something that's going to be very interesting to see. We saw, tariff news related to Apple. So Apple was threatened tariffs if they didn't onshore their development. So although not a lot of their development doesn't come out of China, they do come out of third world countries. And Apple made this statement that, hey, we're not heavily invested in China, so these high tariffs won't actually hurt us that much. But Trump said, hey, Apple, if you're not willing to work with us and onshore some of your company in the development of your iPhones, the chips, the chassis, and all your technology, that you won't be exempted these tariffs like we previously thought, because smartphones and chips were things that he did not want to put tariffs on because they're essential to the American economy. So it's going to be interesting to see how that turns out. And Apple was also hit with a double whammy in the fact that they went and had their decision ruled on for the Epic versus Apple lawsuit, where Epic Games, the makers of Fortnite, they said that, well, Apple claimed they couldn't have a link go to a third-party website out of the App Store and then charge to that, because then Apple wouldn't be able to get part of that revenue. Apple takes a revenue split with all the companies on the App Store when purchases are made on the app that's developed on the App Store. So if for purchases Fortnite had a link go out to another website, Apple wouldn't be privy to any of that money. So this lawsuit has gone on for a couple of years, and Fortnite was off the App Store for this because they didn't see it as fair. Apple took a great hit from that. But recently, the courts came out and they said, yeah, Apple, they're totally fine to do that. You can't basically monopolize the game industry and take your revenue share off of everyone at a high rate just because they're on your app store. So we've seen other companies kind of strike back after this and eventually post their third-party links, the received payments. And I won't be surprised if we continue to see this, because it was found legal that companies do that, and Apple legally cannot go against that. So that was just incredible to see for the free market. No one wants to see a company kind of stomp on all the competition and not give anyone a chance. So another company I want to look at for the month was United Healthcare. Now this one's interesting. We could look at the 1 month, but let's go out to even year to date. I think this will give us a better picture. So we're all familiar with what happened with Luigi and the assassination of United Healthcare CEO and his disgruntlement with the healthcare system. And a lot of Americans sympathize with this. But recently, they came into even more turmoil that's disconnected from the situation. So first of all, the CEO stepped out, and seemingly after that, a lawsuit came out claiming that United Healthcare has been involved in healthcare fraud. And they deny any claims of this. They say they haven't been reached out by the Justice Department, but it seems on good authority from some of these news providers that they have actually been pursued in an investigation for healthcare fraud. So it's going to be interesting to see how that turns out. We don't even know what the nature of the charges are, why they're being charged for that. I don't even know what would constitute healthcare fraud on a mass scale. So when that does break out, if it is true, it's going to be incredibly interesting to see. And the market is reacting properly. They are very concerned because if you're being investigated for fraud, you're probably doing things that make your profit margins illegal and that they're going to be drastically cut. So we can see year to date, if we start from the beginning of this year, January 1st, that the stock is down 40.52%. And we can see precisely where this news came out. So April 16th, everything seemed good. Year to date, they're up 50%, crushing it. And they go from up 15% to down 16%, minus 30% in gain in a single day because of this news that broke out. Everyone was concerned. No one really knew what was going on. And that happened. And then they also suspended further guidance for 2025, basically saying, hey, we're not going to have our guidance for the year. We're not going to give estimates of it. So everyone's left in the dark. We don't know what to compare to because United Healthcare pulled their guidance because they're unsure of their cash flows. So on one end, they're claiming, hey, we have no idea what this lawsuit is about. On the other end, they're saying, okay, we're going to hide our financials. We're not going to necessarily give predictions out in a meaningful way. Why? Those two things work against each other. So it seems that I can't even imagine a world where United Healthcare wouldn't be alerted of a crisis like this. The CEO steps out at a very convenient time, saying it's for family reasons, of course, but I think all that goes to show that, hey, there probably is a lawsuit out there. United Healthcare doesn't want to admit it until it's truly public, and they have to. And they're going to, of course, deny all claims of wrongdoing, and it's going to be a long, dragged-out process. But, I mean, I can't imagine this is a good thing for the stock. I mean, revenue has been great. Their free cash flow has been increasing greatly. So people are seeing this as a value play, and it definitely could be. To me, I wouldn't touch this with a 10-foot pole because there's so much uncertainty. When you're investing, you want some sort of certainty. You want some sort of moat for these companies. Okay, United Healthcare might have a moat of sense where they have such a strangle on the healthcare industry, but there is no certainty. No one knows what's going to happen out of this. They could literally be caught doing like finance fraud too alongside this, and that could just crater the stock. Okay, you want to make a bet on that kind of thing not happening? I won't be too sure because if they're doing healthcare fraud, I'm sure, where there's smoke, there's fire, and there's a lot to be concerned about with this. Now, earlier in the video, we talked about wanting to add more stocks to the portfolio, and I said, hey, I'd be comfortable going up to, 5 at the max. It could be anywhere from 3 to 5, I think is a pretty comfortable range. And the only way to do that is by researching stocks. So in this case, I figured, hey, let's use some of our stats knowledge here and analyze the fundamentals of different stocks. And for this month, I chose to look at Home Depot. So I'm kind of choosing companies out of the S&P 500 that, they're well known, of course, but they're not what's getting the spotlight. 'Cause I feel like when something's getting the spotlight, it's very hard to find value there. So for Home Depot, I found to be in that sweet spot of, hey, this has been a stock that's pretty hot, but it's not on everyone's radar and it's not commonly talked about. So just getting a fundamental, we can see the stock price, and this became public in 2009. And we have metrics up to the beginning of 2025. So it raised from being, I think it was around $20 when it started, to being over $400. So that's 20 times the stock price in 16 years, which is just incredible growth. So I wanted to ask a question, is this now overvalued, or is there still room for Home Depot to grow? So looking at some of these metrics here, this top line we got is revenue, then we got cost of goods sold in the red, and dark blue is gross profit. black is operating expenses, and then the green is free cash flow. So we can see that revenue has been increasing, similar to what we would see in the graph. It's been going up greatly. But ever since 2020, we can also see that that increase in revenue is greatly contributed to the cost of goods rising. So a lot of the revenue comes from the fact that they had to deal with that post-COVID inflation for their products, and they had to raise the cost of their products to the consumer up greatly just to keep up with their margins. And they did that, and they were keeping up on their margins. So I'm not too concerned about that, but it is something to note because although, the American consumer can bend, they can only bend so much until they break. And now we gotta start asking that question, where is that breaking point? Because for a lot of people, it's already happened. And Home Depot, at the end of the day, isn't necessarily a needed product. It's a luxury product, So a lot of these home items, this decor, the lights and all that, on occasion they might be needed, but a lot of people go there for home improvement. It's not, for home necessities. So this becomes a luxury product at the end of the day, in my opinion. We can see gross profits also increasing, which I like to see, but I'm much more interested in the free cash flow, which is green line at the bottom. And, it's been nice seeing that it doesn't just stay stagnant, but it's been increasing over time. But what I do like to see is that operating expenses have been staying relatively low. Now, if this was increasing at a faster rate, that'll put a lot of pressure on that free cash flow. But in reality, it's been pretty steady, and it's increased, which is to be expected because inflation increases the prices of everything, including operating a business and salaries of your employees and all the good stuff that goes into operating expenses. So now we can look at margin, and this was determined by having the revenue, and then you're also going to have that gross profit. So gross profit divided by the revenue. You can see that 2012, 2013, they peaked at over 34.5% on their margin on just selling their products based on the revenue and gross profits by selling their products. And that ever since then, seemingly, it's been on the decline. So as of the early 2025, that's below 33.5%, which would be overall over a 1% decrease in their margin. So it's nothing insane. It's not like they're losing 5 to 10%, but it is important to keep a note that this has been seemingly a steady decline. So as inflation prices have been rising over time, although the margin isn't extremely impacted, we do see that pressure that inflation is putting on, that they're not able to keep the margin on selling their items. So as inflation hopefully gets under control, we'd hope to see this stagnant, maybe come back up a little more. But it does, reveal a scary fact that, these outside third-party forces, it's going to put that pressure on the margin. And especially when we talked about tariffs earlier, Home Depot is incredibly, affected by tariffs. A lot of their products come from out of the country, so they're going to have to raise up those prices in correspondence to the tariffs. And I said the American public can only bend so much until they break. Or tariffs at things that, make that make or break situation with Home Depot and then affects their revenue in the end. I think they could definitely be, but that's something we'll look more into. Then here, this chart doesn't tell you too much. You can see this is year over year difference. For the orange, we have free cash flow. For the red, we have operating expense. So free cash flow, it bounces up and down, but overall it's increasing. Obviously, we want to see that. And when it comes to operating expenses, also this bounces up and down, but that's overall increasing, which you wouldn't want to see. You would want to see operating expenses staying relatively close to zero, which it did up until 2016. But then beyond there, it's getting a little out of control, especially post 2020 when you had operating expenses increase over 20%. Which, sure, during that time you had free cash flow of increase 40% year over year, that rebound back from COVID. But operating expenses over 20%, especially inflation wasn't kicked in at that time, it seems a little too fast to me. Now here is the difference between those two values. So the blue line is calculated free cash flow minus operating expense, and this is year over year. So the difference between their year over year increases. And overall, we'd want to see this stay positive. We want to see free cash flow increasing at a faster rate than operating expenses. And it's hard to tell based on the blue line alone how this is working because it seems like it ping pongs back and forth. Overall, yeah, it's above zero, so that's what we want to see. But there's still some really big drawbacks. And I'm not sure why, honestly. You'd really have to look deeper into the company on these drawbacks. But you don't want to see the huge drawback. You want consistency in this. You want a stationary model almost, but one that's also increasing. so integrated stationary. But if you look at the red dashed line, that's the moving average over 3 years. So this starts 3 years, that's when it kicks in. And we can see that up to 2015, kind of as we talked about earlier, this value is increasing. And that's good. You want to see an uptrend on your free cash flow increasing faster than your operating expenses. But ever since 2015, free cash flow has been dropping. And that's something we don't want to see. That's pressure showing your expenses are catching up to you and your free cash flow is not maintaining at the same rate. Now, that's not to say it's not at a decent rate. I mean, at the end, we're pulling, 8%, right? And that's all relative to the company and how it's valued. But Home Depot, people are expecting fast free cash flow growth. And quite frankly, I'm not seeing that. I mean, if you're talking about 2017 times, you're over 10%. Now that's great. We do like to see that, but I'm not seeing it here. I'm not liking that difference. So it's going to be something that takes more looking at, but I mean, we can look up here and see that free cash flow difference in orange, and as of recently, it was negative. We don't want to see that, so I don't know. We're going to have to keep a closer look at it, and this shows the moving average of that free cash flow. And again, this kicks in after 5 years, so a little different than a 3 year. I wanted a more stable metric, one that's not going to fly as much with the ping pong's back end valuation. But we can see it's starting at above 10%, and this stays relatively similar, but it seems like maybe, I mean, we had that downward pressure post COVID, but then even after that's coming back. But it seems that year over year, our growth of free cash flow on average over 5 years, it's sitting above 10%. So maybe 11, 12%. I'd say 12% is probably a pretty safe number to call free cash flow growth. And now on its own, that number doesn't mean anything. It's all relative to discounted cash flows, which we're going to look at now. As of today, Home Depot is valued at $368.29 per stock. Now, is that fair value is a question that everyone wants to know. And the best way to do that is doing a discounted cash flow model. And there's a couple ways you can do this. You can do it based on earnings per share, free cash flow, or dividends being paid out. I prefer free cash flow. I think it's most connected to the business and what's actually happening. And I mean, some companies such as Morningstar, you can look as a benchmark when it comes to free cash flow, but it's important to have your own opinion and also look at other people's opinions. So as you can see here, Morningstar values it at $308, and they use some of their own metrics, which are on the screen. And I mean, you can decide whether that's fair or not, but I'm going to kind of go based off of what I saw earlier. So looking at this website, we can see the basic numbers they plugged in. The only thing I'm going to change, a couple things I'll change here, I guess, but discounted rate, 10% is more average, and that's kind of what you'd expect of the market. Growth rate, I saw it sitting at about 12%. They have 12.7, but we're going to just be a little aggressive on it and say they're going to grow at 13% in free cash flow for 10 years. Now, I don't think that's the case, to be frank. I think it's going to be something more like 10%, and we'll plug it in at the end to see if that's even doable. But I see a lot of pressure on their free cash flow, as I discussed. And then, I mean, we can see we'll leave terminal stage at 10 years of a 4% growth rate. With these numbers in mind, fair value for Home Depot, based on the information we have now, will be $326. Now, that is way lower than the current stock price, which is $368.29. That's about $42 lower. So there's a lot of downside. It seems like it's saying 12.72% downside on margin of safety. So we want to see that something is not only slightly undervalued, but greatly undervalued to make sure it's a worthwhile stock. As soon as it gets in that overvalued range, and I'm giving numbers that I don't believe in, I think are quite bullish on the company, then we should be concerned. So based on these numbers alone, I wouldn't really, and not stock advice, I would not really look at Home Depot as an investing decision. We can mess with the numbers and tweak them to see what would make it fair value. I mean, we can assume a growth rate of 14%, you're still overvalued. 15%, you're at about fair value. So you have a margin of safety of 1.61%. Cool, right? Yeah, great. Now you're undervalued. Barely undervalued. To make it into the, better range, get in their green range here or whatever, you're going to have to assume a growth rate of 17% in free cash flow for 10 years. Now, from the numbers I was looking at earlier, I said 13%, and I thought that was already aggressive. 17%, they're going to have to do something incredibly different. I don't know if this could even be arranged with them, quite frankly, on what I was seeing. I mean, there's definitely news articles which we will look at that, you can maybe make the argument for it, but I just don't see it. Some interesting things about it. They have a 2.46% dividend yield, so I mean that might give you a little bit of safety, but that should be factored in when it comes to DCF valuations. So it's irrelevant in this case. Some Sharp ratios that they're operating at: 1 year 0.61, 5 year 0.46, 10 year 0.62, very similar to the 1 year, and all time 0.71. All these are below 1, and I mean they might be around market, slightly higher than the market, but you're taking on a lot of risk for a lot of uncertainty, in my opinion. There was a lot of, well, probably less uncertainty in the past, I would estimate. But with tariffs and seemingly their operating expense issue and them not being able to keep their margins up, I think you're looking at a lot of risk for, potentially a good amount of reward, but not nearly as much as the hassle is going to run you. So I think kind of to close this, it'd be good to look at some articles revolving around Home Depot, as these might give some more light into the situations and maybe behind the numbers that we're seeing. Looking at this article from TipRanks, which I'm going to link below along with the following article, I think there are some highlighted concerns when it comes to Home Depot that kind of maybe express the numbers that we're seeing and give us an idea of how the future is going to look. So we talked about tariffs and the fact that a lot of the products that they receive are from outside the US. And, granted they might not be from China, so not achieving that high tariff rate, but nonetheless, they're going to receive that baseline of 10%, if not more, depending on the countries that they outsource their products from. And we can see that this article says they had a diversified supply chain, 50%. So I don't know why they claim that's diversified necessarily. 50% of sales being subject to these tariffs, that's quite a bit, and it's going to be felt across margins. So again, tariffs kind of, put that down pressure on free cash flow, which I talked about. Housing market. Housing has become extremely expensive. Mortgages have increased. If you try to get into housing, you're going to get a high mortgage rate. But additionally, people that already are locked in, maybe at a low mortgage rate, they're feeling it still on property tax increasing after all this house valuations have been increasing. So there's that. Job market's pretty cooked, to be quite frank. A lot of people are struggling to find raises to keep up with inflation. If you haven't been in the job market for a little bit and you're trying to get into it now, good luck, because it's very competitive. It's going to be very difficult for many people. So, when people are already getting pinched on their budget and, rates on everything, credit card rates, for example, are going up because of the Fed rate, those kind of things lead to a pinched budget. And as I said earlier, and we're going to refer to that, Home Depot is not a necessity for a lot of things. Sure, some maintenance, if your lights go out and you need to replace a fuse, sure, that's a necessity. But a lot is, just extra funds in their account that they're going to be spending. And when your budget's getting pinched, Home Depot is going to be one of those first things they go. They're not at the top of the list of, hey, I need to, plan my budget around going to Home Depot. No, it's, food, groceries. You're going to be paying your mortgage off, paying your car notes. Be prepared for gas. All those are the things that come to mind, not Home Depot. So they're in a market that is very subject to economic downturns. And I feel like that could also go back on their revenue. And if the revenue decreases, so does the free cash flow. And year over year, that won't be as high as we need it to be to keep up with fair value. Rising finances, we see in the bond market recently, those rates have been going up. And for everything that Home Depot finances, which I feel like I should have looked at, probably their analytics, the more financing they do, the more subject they're going to be to having higher expenses due to this, and that's going to bring free cash flow down. So if they finance a lot, or they were planning to do a big financing, that's going to be affected by rising bond rates, because then anything they finance is going to cost them more. So you got that downward pressure working against you. And they say pricey stock in a tough spot, and that's a very good way to look at it. I feel like that's kind of how we've been talking about this stock. They're in a position where they're at a high valuation, and they got a lot of headwinds going directly at them. Now, one thing which I did see that they did recently, and I saw this in the valuation of it too, was that they had a recent acquisition of SRS Distribution, which is a company that has a wide distribution network. So this is something that could work in their favor. It could bring operating expenses down to get these products, Cost of goods sold could potentially come down from this too. Everything being more streamlined means you save money. So hopefully the acquisition of this company, which costed 18.25 billion, not chump change, definitely for Home Depot. Hopefully that could help them, but we'll see. I mean, this came into effect in Morningstar's valuation. They raised the value of Home Depot, so obviously they saw this as some bullish report and that it, favors well for the company. And I would be in agreement with it, but I think, small good news doesn't outweigh big bad news. So overall, I'm saying Home Depot I would stay away from personally based off of what I've seen. But I mean, there's definitely a case that can be made for it, and I think many people are making that case. But for me, it's just not quite in my appetite. So we're gonna stay away from it, and hopefully next month we'll have a little more luck and look at a stock that I'm potentially a little more interested in. So let's get into our spreadsheet, look at how the portfolio has done over time, and talk a little bit about that. All right, to sum this all up, let's look at how our portfolio has done over time and some new stuff added to our spreadsheet. So we can see that we started investing with a measly $2,200 back in March of 2021. So we've come quite a far way from there. We can see now that our portfolio stands at $18,138. If we're going to compare every investment we've ever made to SPY would be at 17,753. So we'll look how that, difference comes into play on the charts on the right, but we're above the market, which is good. And we can see that our contributions are now up to $12,845, which over the last 2 months is $800 more dollars. So I think great progress there considering what stage in life we were at. And if we look at portfolio profit over here, we can see the red line being a moving average with this. But 2 months ago, we were only at 3,000, about 800, and since then we've come all the way up to 5,300, so $1,500 worth of difference in 2 months. So we've gained a lot of that profit back, and we're almost sitting at our all-time high. We're just down by about $30. So basically at our all-time high again, which feels great. We had a lot of rebound. Some of that is definitely attributed to the fact that we put $500, which, for large portfolios wouldn't be a lot, but for ours, it is. We put $500 in at that, very low point. So we got to ride a lot of the market highs on the way back up. So front loading our investments paid off there. We can see the difference between our portfolio and SPY. I always repeat it, but in the beginning, we were kind of going with some M1 Finance funds that they had set up for me, and I was just trading kind of random stocks, and we weren't doing the best. So we were down $320 compared to the market, and at this time this is a pretty significant portion of our portfolio, so obviously we were feeling it, but these were also down years, so it made sense that maybe some stocks were being hammered harder than others. But looking at our moving average line, we continually crept our way up, and last month we were down, let's see here. So last month we were down $140, but now this month we were up $383. So we beat the market by $520 in that time period, which makes sense because a lot of tech stocks rebounded. But the point being, and we can see our moving average line kind of depicts this, that we're consistently performing above the market. And I don't claim to be smart in any sort of way here, but it's probably just from QQQM being the majority of our portfolio. As I said, QQQ has a 1.2 beta, so we're expecting for every percent that the S&P moves, we get about 1.2% due to the higher beta. So that's probably where a lot of that came from, and that's kind of my thesis when I was changing up my investment to that. But at the same time, we do have a 40% holding in the S&P. And that's because although I have a higher risk tolerance, and I mean, especially compared to people of older age, I can only stomach so much loss. And if I was 100% in QQQ when the markets were taking their tariff day, yeah, I probably would have grew a gray hair. So again, I'm seeing how this split kind of pays off, and I'm reaping the reward of taking a minute to think about it and changing my preferences accordingly. So QQQM, we have $11,000 in, 51.65 shares. Cost basis of $168.87. So on that position, we're up $2,300. For VU, we're at $7,098, 13.101 shares of that. Cost basis of $451.92. So that's quite more costly to get one share of VU than QQQM. And that position has a profit of $1,177. Now I've changed up. I used to have SPY, I used to have normal QQQ before, so this profit doesn't nearly encompass everything. But we can look at these numerics on the right. We have a balance of $18,137.58. Contribution total of $12,845. So that means the profit in our portfolio is $5,291.99. And this balance is compared to the SPY over there we talked about. But overall, it's a 41.2% return on our money. And I've been in this account since I was 18, so 4 years. And that'll be a little over 10% just doing basic math. But to consider that I've been building up my positions over time, I'm more than happy with this number. And we've seen a lot of success from the market and kind of rode off of that. We talked about our hood and CrowdStrike positions before. Those have done incredibly well. And annualized, they were great. Talk about our Google here. So I expressed that sold out Google and kind of gave a little bit of like a reason why I did that. And if we look and we annualize it, that'll be a 3% annual. Obviously, that's not as good as we'd like to see and would underperform the market. But I'm going to change these numbers around in the future to take into account when these positions were held. So I'm kind of looking at that first bought date, and we got closure date set up. So we're going to be working on that and comparing it to the S&P during that time frame to truly see if we outperform during that time frame. We had a good investment during that time frame because that's what matters. I mean, I could have an annualized 3%, but then that market during that time was, maybe negative 2%. And then we outperformed it, even though on average that wouldn't be up to par for, comparison to the general S&P market. But lastly, something I did, which is something I'm going to keep working on, I'm having fun with it, was looking at our bets that we're making on Robinhood, the prediction markets. So we have no open positions on the prediction market, but we do have plenty of closed positions because I did some this month. So before our last reporting, we had the under $3.2 in gas prices. So since then, we have above 4% on the Fed rate. We have below 2.4% inflation, below 2.3% inflation, and below 2.2% inflation. And I adjusted these equities appropriately. We had 25 shares at 76 cents for the first one, 10 shares at 49 cents for the second one, and 10 shares at 21 cents for the third one. And for all of these, for the first three of those, they all hit. We were correct on those. The last one we weren't correct, and that's totally fine because I kind of figured that 2.2 inflation, that wasn't going to happen, so we actually had less equity in it. And maybe I'll make a deeper video on this, but I use Fed nowcasting. I modeled their past performance, looked at the deviation of the results, and I calculated whether all these bets were expected value or not. And all of them were expected value at a great margin. So we bought all of them, and I kind of adjusted the risk of them appropriately. But yeah, it was a tough month. It came in a little hotter, so there was a chance at first we were actually going to get that below 2.2 inflation, but it came in higher than expected. Nowcasting changed their report later on, so that's totally fine to me. And we make profit off all of these except that last one, of course, which we lost $2.10. Hurt a little bit, but we're doing well over time. I have the running profit running on the right. And we can see the chart here, how these values have changed over time. We started at $1.25 profit. We can see in the last month, that's where a lot of our profit came from. And now we're sitting at $6.82 of profit. Again, definitely chump change, when you're comparing to what we're doing in the main portfolio, but it's something we're messing around with. And if we can use that to maybe hedge bets or just make some, casual money here and there, I think it spices things up a little bit. I wouldn't mind making, videos on predictions for these because I think there's a lot of publicly available information on the financial ones. So especially when it comes to Fed rates and inflation, those two I can definitely work with. GDP growth, something more interesting that I have to look into, but I couldn't find an easy way to calculate expected value for those. So hopefully in the future we can find something better. But overall, where this portfolio is sitting, I am more than happy. I think we had a great rebound this month, rebound last month, and hopefully it will do well this month. But even if it pulled back, that's an excuse to buy more. We've upped our weekly buyings in $100, so I think we're at a great position. And nearing the end of the year, when we need to make up the difference, we're going to max out our Roth IRA. So very, very happy with where we are in this in life. So make sure to tune into the next one. We're going to have another stock view. There's going to be some videos probably in between that because I want to upload more consistently. But like the video, subscribe, share with your friends, family, rewatch it, and watch those ads. Thank you. Take care.